I like to say that, and people don't like to hear it, but I still say if you don't have time to do diligence on a deal, you probably shouldn't be investing. Like, it takes time. You will probably pass on more deals than you invest in. I think that's healthy. And the reality is these things take time, and I think they should take time. Many people just kind of like make split-second decisions without giving it enough time.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Aleksey Chernobelskiy, who is a very interesting individual as it relates to where he fits into the real estate sector. So in general, from a background standpoint, Aleksey came over to the U.S. when he was 11. He's an immigrant. Very highly educated, quadruple major in finance, math, economics, and accounting. Spent many years running Store Capital's $10 billion commercial real estate platform. Oversaw underwriting, was very involved in other facets of that organization as well. $10 billion. It's a massive organization, and Aleksey was integral as it relates to underwriting new opportunities and managing that portfolio. And the reason that I wanted to have Aleksey on the show was because he's carved out a bit of an interesting niche within the overall real estate sector as it relates to the services that he provides LPs, limited partners, passive investors, really anybody who is passively investing in opportunities led by some kind of sponsor or GP, typically syndications. And I came across him and his business just by being active on Twitter. He's very active on Twitter and is a great follow on Twitter as it relates to the insights that he shares with the real estate community. And essentially what Aleksey does is he advises LPs who are looking to make investments in syndications, which outside of that being done on a kind of a casual basis, a friend helping out another friend or a friend knowing that they have a friend who's in real estate and asking him or her to look over this deal that they were sent, doesn't really happen either at scale or in a productized and serviced way, right? In a way that has actually been structured as it relates to a consistent service that's being provided to these folks. And as a result, Aleksey is an incredible resource as it relates to LPs who are looking to avoid making syndication mistakes. He puts out a ton of free content on Twitter. He's got a great Substack that I highly encourage everybody to check out and to subscribe to. And in this episode, we talk all about some of the red flags as it relates to LPs investing with sponsors, a lot of changes in the marketplace, how LPs can navigate capital calls if they're getting hit by their sponsor or the GP that's operating their deal with a capital call. What happens after that? We talk a lot about common mistakes, the 3 pillars of LP investing, and whether you're an LP or a sponsor, this is going to be a great listen for you, right? Obviously, this is helping LPs, but if you're a GP or a sponsor, you should understand all of the common LP mistakes and craft your offering to alleviate those concerns and to speak to those concerns. And this is going to help you become a better sponsor to your LPs. So this is a great episode. We just kept going and going because we kept getting into great topics. Highly encourage everybody listens. And if you do enjoy this episode, please consider leaving a rating and review. And if you're watching this on YouTube, please subscribe to the channel. And again, I hope you all enjoy this episode, and I'll see you guys in the next one. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. As mentioned in the intro, joining me is Aleksey, who is an interesting individual as it relates to the overall multifamily or real estate sector, as it relates to who he's helping, who he's advising, and where he sits in the business. And obviously, you just heard me run through his bio and give a little bit of an intro as to what we're going to talk about today. But the reason I wanted to have Aleksey on the show is because he's cultivated an interesting niche within the business as it relates to who he advises, who he helps, and what his role is. And we're going to talk about all about it today as it relates to how LPs can become better investors, how LPs can better vet operators, a lot of the common mistakes that LPs make when investing in private real estate transactions. And fundamentally, too, just a little disclaimer at the top here. Aleksey is not affiliated with me. We're meeting right now for the first time, and him being on the show is not an endorsement of our business in any way. And it's important to mention, just as it relates to his business, his service, and what he's providing to LPs as it relates to the fact that we have an objective relationship as well. But with that being said, Aleksey, why don't you give the an audience a little bit of an intro on who you are, share a little bit more about your backstory, and let everybody know how you got to where you are today.
Yeah, thanks. I really appreciate you having me on. in terms of background, I guess it depends how far you want to go back. I'll just try to go fast. I came to the US when I was 11, went to school, very much prioritized school over experience, and ended up collecting 4 different majors. And after graduating, realized that that wasn't the right path. But nevertheless, had some really good experiences. I started in algorithmic trading, did some distressed debt, um, and then venture capital, private equity type work, and then did a little bit of consulting, and then finally kind of like landed in real estate when I moved to Phoenix, which is where I am now. And in Phoenix, I worked for a company that used to be public called Store Capital. I ran the underwriting team there as well as the portfolio management team, which consisted of 20 people. At the time, roughly 2,900 properties, I believe, all across the U.S. And so, in many ways, my job was every day to make sure that the assets are in a good position, on anything we currently hold, or held, I should say, and also anything new that we buy, which we bought typically 1 billion plus of every year. My job was to make sure that the risk reward of the deal made sense, right? Um, and that kind of leads us to today. Like I left Store getting close to 2 years ago, and have had a few different interesting ventures since. My most recent one is, as you said, around advising LPs. And to be candid, the most important thing about this to me is just like I kept having friends reach out to me about deals. Um, and I started realizing that there's an interesting niche in the space. Like you essentially have extremely wealthy people, extremely successful people, smart people, that made a ton of money, in some shape or form, typically not through investing or real estate or both. Um, and they tend to make like unrational decisions, or sometimes uneducated decisions, um, when it comes to investments. And I that initially struck a chord with me. I really love education. I obviously am pretty nerdy and I like, deals and underwriting stuff. So it got pretty interesting, So I started a venture where I advise LPs. Right now, I write about it weekly, from all the existing deals that are necessarily going well, and there's always lessons to be learned. I try to kind of anonymize everything to make sure that the LP and the GP aren't impacted, but the audience on my Substack can still learn from it. Um, and yeah, the business has kind of gone in many different directions. We could talk about that, but I'll stop there for now.
Yeah, I think it's interesting because I don't know just off the top of my head, just quickly thinking about it, somebody that's formalized that type of service. I know a lot of folks that are GPs, right? And maybe they have a personal friend that's looking to be an LP in somebody else's deal and they take a look at the deck, right? And they share some
Yeah.
thoughts, right? And I think that happens, probably not as much as it should, as you mentioned, right? There's a lot of wealthy folks that are writing multiple six-figure checks that maybe haven't done enough diligence as it relates to why they're making that investment or to the merits of that investment, which is surprising thinking about that significant of a dollar amount. And but as you mentioned, it's not something that I've necessarily seen formalized, which you have in a way, right? I would like to learn just a little bit more about how you get into it. You mentioned that you were just doing it as a favor, and then I would imagine there was a natural progression there. Maybe you can talk about the role of Twitter in this whole adventure, right? I know that's how I first learned
Yeah.
about you. And talk
I
about how
mean,
this business came to be. Yeah.
to be candid, Axel, like the business, I don't think would be here if it wasn't for Twitter. I started the entire thing on Twitter. I beta tested the entire thing on Twitter to the point where even when I got like the way that this whole thing started was a friend of mine who was an attorney asked me to look at something. I talked to him about it, and through the conversation, he was just asking like he was making statements like, well, like I know my investment is safe, but can you make sure the upside makes sense, right? Can you take a look at this? The everyone needs a place to live, so this seems like a really good investment. Like, the sort of the typical statements that you hear, which aren't necessarily completely false, but there's also another side to them that people not from the real estate world tend to forget. And so I helped him, and his response was just like, wow, like I had no idea what I was doing. I'm so glad I reached out to you because I was about to invest a few $100,000. And it just occurred to me in that moment. I literally just went on Twitter right after our conversation, and I was like, hey, I think my tweet was something like, why isn't there someone who charges $1,000 to give people independent thoughts on a deal before they invest $100,000, let's say, or more, right? And that tweet, it didn't necessarily go viral, but like it had a decent amount of traction to where I got feedback. Some people were like, "This is stupid. It's never going to work." Some people were like, "I really wish I had that because I probably wouldn't have gotten screwed." And I got enough interesting feedback, and also I saw some competition. It seems like there's some people that do this, but I didn't see anyone doing it at like a large enough scale. So the fact that there was people doing it, to me at least, meant like it's probably a real business. But that there was not anyone doing it on a massive scale also meant like perhaps there's room to enter the space. And like it's just me. Like I don't have like some fancy operation, so I figured like what's going to happen if it doesn't work out in a few months? Let me give it a try.
Mhm.
And like I've been sort of documenting the entire journey from scratch through Twitter. I write on there. I write on Substack. I just like update people as I go along.
Love it. No, you're a great follow. And what's funny is I assumed I followed you for like a year, but I didn't. And it was just your tweets kept popping up on my feed just because
Oh, this is
everybody that I did follow
good.
liked them. And then I was like, oh my, I can't even believe I didn't follow him. But maybe we'll return to that at the end of the show. But for everyone listening, Aleksey, great follow on Twitter. I'll link to it in the show notes. But it's a service that is required, or not. Not it shouldn't be required, but there's a lot of use for it, especially as more and more individuals become interested in alternative investing, specifically investing in alternative assets like real estate from a passive standpoint, and they're partnering with other operators. And the absolute chasm of knowledge between I want to go and invest some money into a private real estate deal comparatively to someone that's been in this business at a high level for an extended period of time and really understands what to look for is just so massive, right? And there are oftentimes folks that are writing $200, $250, $500,000 checks that are maybe going off of feel or just a personal relationship with a sponsor or GP or just a referral from somebody else in their network, but they're not actually doing the diligence required to make that type of investment. And when you think about when you're putting that kind of capital to work in other fields, right? If you're going to go buy a business for a couple $1,000,000 and you're going to go put $500,000 down and get some bank financing, there's an absurd amount of vendors and service providers surrounding that transaction. Whereas investing passively into a real estate transaction, there's just less friction, right? There's not that type of support. So I think it's a very interesting model. Now, I do want to shift to some fundamental best practices if you're an LP and you're going to go out into the marketplace and invest passively. And I'm going to start kind of high level, and then I want to start working down into more specifics, and then we can wrap up the show with some more current events type of topics. But let's start with this first one. I believe in your own words, you've defined kind of 3 pillars of LP investing, hoping that you can define them and then maybe elaborate on them and we can get into those.
Yeah. There's 3 pillars, just to name them. First are execution, i.e. the GP's ability to execute on a deal. The second one is alignment of interests specifically between the GP and the LP or LPs, or GPs, I should say, because sometimes there's more than one GP. And then the third one is the actual underlying investment, which is the property or perhaps the business or the VC investment that you're going into. I think it might surprise people that the underlying asset, so to speak, is last, and I fully stand behind that. And the ordering is intentional. So I'll go through each one just for a brief minute, and then obviously you can dive in as you'd like. So broadly speaking, the first one is the ability for the GP to execute, right? So that includes a lot, right? I think it starts with trust, right? Like, do you trust the person? Are they trustworthy? Like, how is their background? Not even just track record, but background in terms of like, have they done things that are concerning in the past? Which, and I always like to say this, just because someone, let's say, doesn't have a track record, doesn't mean anything other than another aspect of the transaction sort of needs to compensate for that, right? So, like for example, um, if a GP is on their first deal, what I really don't like seeing, I will just be candid, is like sometimes I'll see a deck that doesn't say that, and it just not just doesn't say that, it almost like paints a picture of an extremely experienced GP, and you have to like sort of read between the lines and do a bunch of research only to figure out that they're like actually have never done a deal on our own. Um, and I think in many ways, like emerging GPs are probably an amazing source of alpha, because they haven't like found all the capital yet. They're probably like really trying to make it and perhaps might work harder, right? Of course, there's a risk to it as well, because they don't have that experience. But all of that needs to be just part of a healthy investing equation, right? Like no investment is safe, totally safe, and no investment is like risk free, right? So like something is if something is missing or perhaps not as good as you expected. So the question is, can something else compensate for the risk reward balance to make sense for you personally? So that's one. The second one, as I said, is alignment of interests, which is, during good times and perhaps more importantly, bad times, what is the waterfall, right? What's the co-invest? Can you make sure that things, if things turn out not as expected, the person is really invested in the future of the property. Um, and then like that article also talks about fees. And then the third one is the property, which like we can probably have a whole hour on, or probably more on this topic alone. But generally speaking, like, are you overpaying? Does the cap rate make sense? Is the NOI correct? Are there like too many pro forma adjustments that are unrealistic? Are you being too aggressive in terms of your assumptions, et cetera, et cetera? That is sort of like the general three pillar framework that I suggest.
No, I think that's great. And I appreciate you elaborating. And, one thing I just wrote down that I think is what I'm taking as the highlight from everything that you just described personally, because I think it's a great way of succinctly summarizing it, is if there is one component of the three pillars or one component of the overall deal that maybe where you're making a decision with either less information, i.e. the lack of a track record, or there's a component of it that makes you feel a little bit more, reticent as it relates to investing, another aspect must compensate for this, in your own words. I think that's a great way to describe it because, we're talking about all of these different things. And while there's a lot of components of investing, and if you do a background check on a GP and they were indicted for fraud, that's probably a no. There's probably not a world in which you would ever invest, despite any other components of the deal making up for that. At least personally, that's my take.
Right.
But a lot of components.
By the way, even that, like, I think it's kind of a personal preference. You get what I'm saying? Like, but what I do want to make very clear is like if you do find something like that, then I hope something goes off in your head and says, well, by the way, I've seen cases where this wasn't true, right? That's the only reason why I'm saying it, is like something should go off in your head and be like, this deal on an absolute basis or relative basis, or is more risky than the same thing without a GP that was indicted for fraud, right? Meaning that it doesn't mean that the fraud is going to happen again, but the chances of me getting into a fraud again is higher than an average person that has, whatever, a 2% probability of committing complete fraud. Let's say I just made that number up. But so I really like that framework because investments and the whole investment universe, really, if you think about it, is it's a relative game. You know what I'm saying? Like you need something in the public markets, you need some things in the private markets, depending on your wealth, and I don't know. Sometimes I hear this notion of like, oh, I have to get into this deal because I'm going to miss it. But the reality is like there's so many others, and it's okay if you miss the real estate deal this week. There's
Yeah.
so many other GPs, so you shouldn't be afraid to ask questions and so on and so forth. But yeah, sorry,
Yeah, and I think
continue.
and maybe I may have communicated it, in a bit of I guess a poor way, but I think in general it's helpful to think about the spectrum of all of the decisions and all of the diligence you need to do in terms of there's no right or wrong answer, right? If you're an LP, there's no right or wrong answer as it relates to market.
Hmm.
There's no right or wrong answer as
Yes,
it relates to a GP's experience. There's no right or wrong
yes,
answer as it relates to a deal structure. There's probably it's a spectrum. There's probably
yeah,
you can have more aligned incentives and less aligned incentives. But I think the way you described it as it relates to if there's something that sticks out, then you must be compensated for it in some other aspect of the deal in order for the risk
right.
profile to maybe align with whatever you're looking for. But I think that's something that's helpful for LPs to understand in general, because I think a lot of maybe looking for yes no answers. I mean, you would know better than I would, given that you speak with them regularly.
Yeah, yeah, and I can touch on that a little bit. Like I'll just give you an example.
Yeah,
Someone calls me up and they're like, "Hey, is a 50-50 split normal?" Right? And sometimes I'll get like direct messages like this, and I really never like to answer them because
yeah,
the answer is, and people hate hearing this, but the answer is it depends. It depends on a bunch of things, such as the asset class, how much experience like in other words, the more successful a GP is, the more they're able to potentially charge more, and I talk about this openly all the time. Um, and just as an example, let's say that deal is 50-50. So I would say, well, like the market is 70 to 80% typically, right? And with the rest going to the GP as the promote. Um, and the investor would totally pass based on that. It's like, well, I don't think you should analyze it that way. And by the way, what if they forgot to check the next slide, which said that the pref was 15%? I'm just making it up.
yeah,
But like, let's say the pref was 15%, and after the pref, there's a 50-50 split. Like, okay, so like that's a whole different equation, right? So and that's why like all of this, to your point, like people like quick yeses and quick nos. I like to say that, and people don't like to hear it, but I still say it. Like if you don't have time to do diligence on a deal, you probably shouldn't be investing. Like it takes time. You will probably pass on more deals than you invest in. I think that's healthy. And the reality is, these things take time, and I think they should take time. And um, many people just kind of like make split second decisions um, without giving it enough time, I think.
yeah. And I think it's just a healthy way of thinking about it, right? When you're an LP and you're analyzing an opportunity in a deal, you have to get out of the binary way of thinking. Yes, no, this is it, black, white, right? Because a lot of investing in these types of opportunities, it's a gray area, and there's always going to be some level of risk in some components of the deal. There's no such thing as truly risk-free real estate investing. That does not exist, period. Right. So there's always going to be risk, and it's analyzing the risk and assessing the risk as it relates to the different components of the deal. And maybe you have
Yeah.
to use your example, right? A 50-50 split, but the team behind the deal has done 50 of these, the same exact deal in the same exact market with the same exact team in the last couple of years.
Yeah.
And the execution risk is extraordinarily minimal comparatively to an investor that's offering a 70 or an 80% upside on a promote, but this is their first deal in this market, right? There's always a give and take. So I
Yeah.
think that's a healthy way of thinking about it.
Yeah, and
Um,
perhaps put it another way is like, let's say you're looking at a deal and it's literally the guy's first or gal's first deal. And you're like, man, okay, like I'm glad that the GP was transparent about that. That's always good. Um, and then you flip to sort of like the waterfall, and it says 90-10, 90-10, 85-15, let's say 8% pref. So you're sitting there and you're like, okay, so on the one hand, the downside risk is a little higher, right? Because if they for lack of a better term, screw up, um, due to lack of their experience, like I'm probably going to lose some or all of my money. But on the other hand, the upside is much greater than what I can get with someone else potentially, right? And to your point, this is I think the hardest thing about this, Axel, is it just takes time. That's like you need to look at dozens of these to be able to compare one to another, and you have to do it across different general partners too. Um, but it takes time, and so I think some people confuse passive investing with, I mean, for the lack of a better word, like Robinhood, where you just, deposit some money and you wake up 10 years later from your ETF or an index fund or whatever. And you have, your dividends and you can sell at any point, so, but that's just not how it works.
Yeah. It's passive once you wire the money, but it's not passive up to that point. It becomes more
Exactly.
passive. It's still not even entirely passive once you wire the money. We're going to get to that in a little bit, I'm sure. But
Yes.
let's switch gears here a little bit because I want to touch on this topic. So you wrote an article titled "Top 15 Syndication Mistakes." I thought it was a great article. I read it, this morning.
Thanks.
Obviously, this would be a 3-hour show if we started diving into each individual one you shared. But maybe you can share maybe 3 or so, right? A small number. Well, I'll suggest 3 if you want to go a little bit more, a little less. You got 2 big ones or something like that, totally fine. But maybe
Yeah.
the ones that most rapidly pop into your mind when you think these are such common mistakes that LPs are making when investing in syndications.
Yeah, sure. I mean, I'll just tell you what I probably most frequently see. Um, Probably number one is, it was really a sub point there, but just like social proof. In other words, people just investing because the person is famous or the person has a lot of followers, or maybe your friend invested with them, so therefore I should too. Like the way that I always think about those situations is, it's great that you got the deal. You should take it very seriously, and I would argue you should take it more seriously than a deal that you heard of from, the guy on the street. Um, but it shouldn't like have a very significant weight. I would say almost close to no weight. I don't know, maybe 10% in your sort of equation of making the decision, if that makes sense. Um, so I think that's one. A second one is, the execution piece, which really like comes from there's a lot to discuss there, but I think the biggest thing is track record. Um, a lot of the common denominators across folks that are getting capital calls now are, generally, um, sponsors that had a little bit less experience, sometimes a bit less experience than others. And so you essentially had like the more sophisticated folks, um, wait the market out, and the other people were bidding everything up. Um, and I always like to say this too, like there's nothing wrong with investing in something, that is risky. Where I have a problem with it, is where you didn't realize that it was risky, right?
Mm-hmm.
In other words, any investment that a person makes, you should have like a decent sense of, like, let's say, the 90% of the different risks that could go wrong. I'm not talking about, like the country getting shut down. There's some things you can't predict, right? Black swan events. But outside of that, you should have a pretty good grasp of the different catalysts, especially the downside ones. And I think the third one, um, is the alignment of interests piece, which is, um, many deals got done where, the GP did not put up a co-invest. I think there are situations where it's okay not to have a co-invest, but again, something else needs to compensate. And as perhaps more importantly, the LP needs to know that if things don't work out, the GP is sort of like less incentivized to keep this thing going, right? Um, and I've seen outrageous fees. Again, like, I don't know if I want to name anything, publicly, but there's sort of like market fees. There's like, way higher than market fees, and then there's like completely egregious fees. Um, when those fees are charged by, the example I gave in the article is Renaissance, like the Medallion Fund, who, that fund has returned more than any other fund over a long period of time. It's like you just like deal with it, right? But when those fees are being charged by someone who's been in business for a year, or perhaps it's even their first deal, I just that becomes pretty challenging, you know.
Yeah, absolutely. And I'm gonna switch and start talking about some capital call kind of current event related stuff because I think that's going to be helpful for everybody listening. But I want to return to kind of the technical side just real quick. You mentioned that third pillar was the deal, right? More or less, right? In terms of like the property or the market or the actual asset itself, right? And that's the third pillar in terms of sequence of importance, execution, risk, team, alignment of interest, the actual asset. But let's talk about maybe some very high level, quick technical underwriting checks you do. Maybe let's say you're an LP, you're opening up a deal, the sponsor sends you their underwriting on the deal, you open it up. What are some of the things you're quickly looking for? Let's assume we're talking multifamily here to kind of narrow the scope down and to make it a little bit more relevant to this audience. Couple of assumptions that really stick out to you that you really want to look at, some other components of the actual underwriting itself.
I mean, I would say three things. So first, just as a reminder, the first thing I personally would look at is not the property, actually. In other words, there's sort of two steps to get through before I look at the property. That's sort of just a reminder. Now, two other things. I always like to focus on downside catalysts. In other words, what in this deal can go wrong and have the most impact on my investment. Typically, especially in like short duration funds, or closed-ended funds, right? Like, typically that's the exit cap rate assumption, right? Like that is sort of like a big one to focus on, and whether you believe in it or not. And then the second one is NOI. Like, and part of that is like what happens, where are we starting in terms of NOI? But sometimes the bigger piece is the NOI on the back end, right? Because ultimately a lot of your proceeds will come from that back end NOI, using the cap rate that's assumed. And many times, I can tell you probably 75% of the time, decks don't have sensitivity tables around those, despite having what I would argue are, pretty aggressive assumptions. So I think that's a big one, and a related one is refi assumptions as well. I see many decks that sort of like have this pop of a refi in like year two. And let's say in year five, the exit is actually like really well explained. But the refi, for example, assumes, 75% LTV at 5%. And you're sitting here and you're like, well, like, what if that doesn't happen, right? In terms of interest rate. B, 75% relative to what? In other words, like, what is the valuation that you're assuming in year two? And in other words, like, lenders might get, a little bit tighter in their underwriting, and they might say, I agree with you on the valuation, but I'm only willing to fund 60%. That's the one thing that can happen. Or they might just completely disagree with you on valuation, right? So the refinance assumptions, especially with deals that like sort of require a refi to
Kind of meet the projected
what I would
returns,
call
right?
like materially impact, the return of the deal. I think it's almost a must to explain those really well. And I've even seen, like some GPs, I think, do a good job of bifurcating the IRR across two things, like sometimes three things. Sometimes it'll be like cash flow, refinance, and exit, or perhaps it's just capital events, right? And cash flow, and I think that's important for investors too. Like sometimes, they don't necessarily realize that the majority of your IRR comes from one event in 5 years.
Yeah, which is interesting to conceptually think about because it's incredibly challenging to predict what's going to happen in 5 years from a
Sure.
market environment standpoint, from an interest rate standpoint, from a reversion cap rate standpoint, et cetera, right? So those, you at least need to feel comfortable vaguely with the assumptions that are being made as it relates to what that NOI is and therefore what the value is of the property upon sale. I'll throw in something else for the listeners, and I'm sure you would agree with this. Rent growth throughout the hold period is one of the most easily manipulated assumptions within a model, right? If you change it from 3 to 4, it almost turns a deal into not being a deal to one that is a deal from a projected return standpoint. And it's because it compounds the change in NOI over time, over the course of that hold period, and therefore has drastic implications on value. And I think that's a great way of thinking about it. So let's talk about a fun topic of conversation here, an unfortunate topic of conversation for a lot of LPs out there at this day and age. We're recording this mid-December 2023. It'll go up in January 2024. A lot of folks, unfortunately, have invested in deals where there have been capital calls or where there's been some level of distress. So I think this is a good current events related topic. How would you advise an LP? And I know they've been reaching out to you just based on what I see on Twitter. LP's in a deal. Sponsor says, "Hey, we need to go and raise some more money. We're calling capital," and this individual is trying to think about: do I make this contribution? Do I double down on this deal? Do I actually contribute more dough? How do you recommend LPs start to think about that process, vet that process, and make that decision?
So I would say two things off the bat. So first of all, I think you should think about it as an investment. And that sounds so obvious, but from my experience, I think a lot of LPs just like rush into it, like as like, oh my gosh, like okay, yes, like I'm wiring the funds right now, like I don't want to lose the property, right? In other words, let's say you invested 500 grand and the capital calls for 50%. So the 250K that you're about to invest could not be invested, and you could invest it in something else. So this marginal investment should not be any different, in a sense, than looking at investing in treasuries versus putting it in the stock market or into another syndication or whatever it is. Like it's a personal decision whether you want to invest or not, and you should treat it as such. So that's one. Two is, I mean, I've advised some people that call me and they say, yeah, like I really need to fund this capital call, otherwise they're gonna lose the property. And my first question is always, do you have the money? And sometimes the answer is, well, I was just gonna pull out my 401k, borrow from there, or like I was just gonna borrow from a friend or whatever. And it's like, well, like that's a whole other level of complexity that you need to think about, because you might be sort of for example, if the investment doesn't work out and the 401k is charging you interest on borrowing the cash, so now you're behind even further, right? In terms of evaluating the capital call, I think they are I think that could be a pretty long episode on its own. I think what I'll say just in short, I mean, so first of all, I have an entire article on it with a model that I think people can look at. The article really focuses on how capital calls are related to a psychological bias, right? In other words, you sort of have this problem where you think that the money that you invested previously is a sunk cost, right? Like that's a pretty famous term. You invested into something, you already did, so sort of, so to speak, forget about it and move on, right? I think where capital calls get, although it is true that it's a sunk cost, I do think it's a little complex, because typically not investing has punitive measures associated to it. It's typically in the form of dilution, right? So in other words, if you don't invest, your original money will be worth a lot less, and many times it's not pro rata to what they raise. Many times it gets diluted manifold. So from that sense, I think you sort of have to look at both cases, and I go into that in the model is like, let's look at the case of investing, let's look at the case of not investing, fix some variables and compare. I think that's the only way to look at that.
Yeah, and I'm going to make another comment, and maybe this sparks something that you want to add. But I think as an LP, if you're hit with a capital call, you need to take a step back, right? Everything that you just mentioned is important to do as well. But if you are thinking about continuing down this road and making this investment, you should still acquire more information about what's going on with the deal, right? Like
Oh yeah.
why is this capital call being made? Is it to finish renovations? Is it because we have a rate cap expiring? Is it because we need to do a cash in refi? Is it for some other reason beyond that, right? And start to accumulate information that allows you to look at the deal from a new perspective, right? So that you actually have enough information and enough of a sense of what's going on to make an educated decision. And I would imagine, and correct me if I'm wrong, a lot of LPs maybe don't ask the right questions or any questions as it relates to the current health of the deal and what the actual situation is. Is this enough money to get us to the finish line, or is there more coming down the line? Are you too nervous to make a big capital call as a GP that you're making a smaller ones just because you want easier conversations, but there's going to be another one that comes? Does rate cut get us 6 months or 12 months? Is this getting us Is this capital getting us to the finish line from a reno standpoint, or just through the next 30% of the units, 50% of the units? So I don't know if there's any questions that come to mind, or if you have anything to add to that, but I think it's a really important part of the process too, right?
Yeah, I actually do. So I think a big question that you alluded to is the capital call enough, right? Meaning, is there another one coming? I think many people don't ask that, and this is just more of a broader statement, whether it's upfront on your first investment, or it's on your capital call investment, so to speak. You obviously, first of all, you shouldn't be afraid of asking questions, A, but B, I think people have this sense of, like, not just being afraid to ask questions, but they just assume that whatever someone else is telling them, because they're a nice person, must be true. And I have another like an entire article on this too, which is something I called like the investor's mindset. And the first topic in there is like, you need to have a healthy amount of skepticism to be like a good investor. Typically, when the deal gets to you, some other people have passed. That doesn't mean it's bad. It just means like it might not be the best, right? And you need to sort of like to realize that. And so going back to your point, when, for example, if you wanted to ask, um, hey, is this money going to get us through the end? Um, that's not a very valuable question, because the answer will just be yes. You
Yeah.
know, I think what's a much more valuable question is like, hey, could you provide a model that shows your business plan and shows me that this money will get us through the rest of the investment? I think LPs would be sometimes scared to realize like that model in some cases doesn't exist. Um, but I would say, if it doesn't, then perhaps that's also information, right? um, so yeah, I mean, I think you're hitting on a big point, and more generally, many of the capital calls that I've seen kind of like follow this template. I just keep seeing it. I tweeted about it as a joke, but in reality, it wasn't even a joke. I just keep seeing the same thing. It's like, hey, happy holidays. Your property is doing phenomenally well. The next sentence is, but we need money. The next sentence is, we are trying to put together a plan, but don't have it yet. We'll get it over to you soon. And the last sentence is, you have 3 days to wire the money. Here are the wiring instructions. And like, when I see things like that, I'm just like, how are you supposed to make a decision? Like, what is my
Yeah.
existing position worth? It's okay if it's worthless. It's okay if it's worth something, but I think that's important. Like, what's the existing state of the property, right? Why do you need the money? Like, how am I supposed to invest in a capital call without knowing that you have a plan? And by the way, this isn't always the case, but sometimes a capital call can come from a sponsor that wasn't the best at executing in the past, right? And so they've kind of shown you a lack of ability to execute. And I again, this isn't always the case. Like, sometimes people are great executors and things just happen. But you know, treat it as an investment. You know,
Yep.
like you really need to ask questions and don't be afraid.
100%. And, you just described a situation that I'm personally in, right? I'm not going to share specifics really outside of just high level stuff, but I'm an LP in a few deals that, couple are shaky. One has kind of gone sideways. I don't invest as an LP in a lot of different things. I only did it in a few just a couple of years ago to diversify what I was personally investing in. The vast majority of my resources go into our own deals as a co-invest, but um, I'm in a deal with an operator that's not going that well, and there was a capital call, and I personally decided myself, dilute me, that's fine. I don't have faith in your ability to operate this deal to the finish line, right? Asked a lot of the questions we talked about here and made the decision that I'm looking at that capital as if I get any of it back, great, that's a win. But sometimes a deal goes sideways, or you invest with the wrong individual, or what have you. And despite the best efforts from a diligence standpoint, I obviously do a lot of diligence. I'm in this on the active side. I know what questions to ask, know what diligence to do. But in this specific situation, some operational challenges within their team, and I just don't believe that if I were to continue contributing more capital to this operation, that it increases the likelihood I get the original investment out. So that's a sunk cost, right? And I think it's important. Yeah. I highly recommend everybody goes and reads your article as it relates to that, because that is a psychological challenge as it relates to being objective when making that decision. You want to chase the money that you already put into the deal and save it, right? I think a lot of investors think about it in that respect, but these are two independent decisions and independent events, exactly. Which is great. Yeah. So one last question before we get you out of here, and this is a topic that I personally don't see discussed too frequently online, whether it's Twitter, podcasts, social media of any kind, and that is assessing the financial strength of a general partner outside of the deal itself. And we're talking about capital calls here. The first line of defense, hopefully, in a deal is the GP themselves. Deal goes sideways, they went over budget on their renos, they need some more money or whatever, the operating reserves ran low. Ideally, you're working with a GP that can extend a member loan or something along those lines to bridge the gap, or can come out of their own pocket, or just call their own capital, contribute their own capital into the deal. Unfortunately, as we all know, a lot of investors got into this game in the last few years and don't have significant personal financial resources to make those kinds of contributions or loans to the entity. But there's a very big difference between investing with a poor financial GP as it relates to the cash they got in their bank account behind the scenes versus one that's got some dough. Do you advise LPs to do any diligence as it relates to the GP and their personal financial situation, even if that's something you can do, right? Because that's a challenge, I would imagine, and at the end of the day.
Yeah, I think we could talk about this topic for an hour too. I have a lot of thoughts. I'm like very opinionated on this topic, and it was actually probably one of the big reasons why I got into this business. I think the answer to your question is, in most situations, an LP, I think it's not market to ask for like the GP's financials. Yeah. In other words, it's just not standard. That doesn't mean you can't do it. But the next question is, okay, so let's say you get the financials, then what? Like, what are you going to do? Like, sit there and put up a 3-statement model of the GP? Yeah, generally speaking, I think, for the audience, it's important to know that a GP is like, it's a pretty difficult enterprise to run. I think LPs need to be sensitive to that. In other words, the economics of the business is you have a bunch of employees and you get paid through the fees of the different properties, unless there's a promote that kicks in on something that you sold. So that's more or less like the two sources of revenue, and all the expenses obviously are all the compensation to the company's employees. So I think the reason why I said earlier that I'm very passionate about this is I think it extends far beyond what you said. In other words, I'll just give you an example. Example one is, Axel, you wanted to invest in someone and they're presenting you this deal. You invest in a property, and then a month later, that GP files for bankruptcy, right? So in other words, the property is still fine. They bought the property, your equity is still there, but due to other investments, right, and with the stuff going on with the GP, perhaps the GPs are fighting with each other or whatever, the GP entity filed for bankruptcy, and then that impacts your performance of the property, right? And forget about just practically speaking. There's like the stress, like there's your name was out there, like it certainly takes away attention from your investment, if not worse. Another iteration of the same topic, I think, is, and I see this a lot, is you know sitting in my seat, like I get a lot of information that's not necessarily public, and I always say, unlike the public markets, in the real estate world, you can totally trade on public information, right? Like that's one of the most amazing things about real estate. So I'll get some offering um for a pref deal, is essentially like borderline rescue capital on a fund, and then a week later an LP asks me to review an investment in that sponsor's new fund. um and and of course that LP is completely clueless as to what's going on, and if you look at their deck, it says like, look at how big we are, so many deals, look at our track record. And an LP would have no idea that something is going on behind the scenes, right? So that all of that is kind of like, it's very much tied together, right? Because if deals are in distress, that indirectly at least means that your promote is more or less worthless, which indirectly means, or really directly means, like your GP is worthless, or perhaps has like a negative net worth. And ultimately it means like the GP is not in a healthy position for going concern sake, and that has like pretty big implications sometimes.
Yeah, I'll mention a couple things and then we'll wrap up. And you're right, this is a whole
Yeah.
another. I'm opening Pandora's box here when we're running out of time, which
Yeah.
is my fault. But a
No,
couple of
no,
other
you're
things,
good.
like if you're an LP, look at the size of the deal relative to what the GP has done in the past as well. If they primarily buy 100-unit assets and they're raising capital for a 50-unit deal, okay, so economically this is a smaller deal comparatively to maybe what they've done in the past. Again, it's an indicator in the right direction that maybe this is something that they're more able to step in and to assist with. Look at their co-invest, right? And it could go either way. A very small co-invest may lead you to indicate that there's cash behind the scenes. Maybe you can ask that question very vaguely, right? Probably get the answer that you're going to have to sift through a little bit further. But on the other side too, if it's a very large co-invest, could lead you to believe that there is some more liquid capital behind the scenes, or maybe they're investing a little bit more. There's all kinds of different little indicators that you can maybe look at around the edges that'll start to frame the deal in a little bit more, or not frame the deal, but frame the GP's financial situation, I should say. I think it's fair to ask too. Have you made member loans in the past when a deal has maybe run out of cash? Again, a GP should be honest with that answer. If they're not being truthful with that answer and you find out about that after the fact, that's very indicative of their character, et cetera. And that leads you to some other conclusions. But I think fundamentally speaking, most folks don't even think about trying to do diligence on that. Whereas, in my opinion, it's one of the more important things to do diligence on, because a financially strong GP is much more likely to protect your investment in a situation where a deal goes awry and not put you in the tough spot of making these hard decisions from a capital call standpoint.
Yes.
But you're right. A whole long topic of conversation. But with that being said, we'll get you out of here, Aleksey. Why don't you share where folks can learn more about you, where they can reach out to you, maybe how they can engage you with your services or potentially work with you, and we'll include all this in the show notes.
Yeah, I mean, I think my name is, pretty unique. I think people can find me. I'm probably most active on Twitter, second most active on Substack, which is where I write long form content. Twitter handle is just my last name. Substack is lplessons.substack.com, and my full name is my LinkedIn profile. And welcome all feedback on anything I write. I also encourage GPs to get involved. I love hearing from them. Like if I say something that is off, like I love hearing it, and always good to course correct. And I think in some sense my mission is um, to help guide LP Capital to better, or perhaps the yeah, like better, let's say, sponsors, the better bunch, if you will. And I think if that's done well, both LPs and existing GPs benefit. So yeah, thank you for having me.
Absolutely. No, this is a great episode. And I think a mission of helping LPs make better, more informed investment decisions is critical. As a GP, I love it when investors come to me and ask me very specific, tactile, educated questions. Because when they do ultimately, if they do decide to ultimately invest, it makes both of us feel much more comfortable with that decision, right? It makes me feel much more comfortable that they are making a truly informed decision as it relates to what their goals are, what they're looking to invest in, et cetera, et cetera. So I think, as you described, it is a win for both parties. And I think you're doing great work. I very much enjoy your
Thanks,
content
man.
on Twitter. Highly recommend everybody follows you on there. And again, thank you for taking the time to come on the show. This was great.
Yeah, thank you so much, Axel.